Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, as always, things are busy. Things are hopping at Retire Smart. Another successful round of taxes and retirement workshops. We've got the estate planning workshops coming up this week. You and Colin Kastrick will visit more in detail on that in the next segment of the show. But David, we must at least touch on what has become an annual event at Retire Smart. Now, the president, of course, gives a State of the Union address every year in late January, early February. And so Retire Smart offers a State of the Market presentation for clients. David, we had about 250 people at the Sack Museum. This has become quite an annual event for Retire Smart. Can you just give listeners a quick sense of what that was all about?
Well, yeah, it's an important event, and this is something I've been doing throughout my career. I even did this in Florida pre-moving to Nebraska many years ago. But it's just giving clients a sense of what's going on. We typically will give a quick review, if you will, of what happened in the world last year, in the economy, in the markets. Obviously, last year was a very unique year in that it was the bond markets and the stock markets both had significant losses, and so that is a rare thing to talk about. But we'll talk about what history says, or we talked about what history says, kind of what that means going forward, and we laid out what we think is going to be coming here in the coming quarters, which is not necessarily the rosiest of pictures, if you will. So a lot of fun, and having that many people show up, and the feedback we get is always phenomenal. Clients appreciate that we kind of keep them in the loop, so to speak, on the economic events, geopolitical events, et cetera. And so and we even sometimes review the previous year's predictions, and the only one we got wrong from last year, unfortunately, was the Ukraine war. We talked about it at the State Union last year. Just wait till the Olympics are over. Within probably 72 hours, you'll have a war going on between Russia and Ukraine. But we literally thought that war would last less than 3 months, and obviously that was a complete miss, on some of the predictions we made. But these events are great. A lot of great economic data shared, and it's wonderful because how the feedback the clients say they really, really find these things valuable.
The venue was great too, the Sack Museum. Well, David, we have several news items here. Speaking of what's coming up in the first quarter and beyond in 2023. But before we get to all that, this, I guess, David, is just a shout of righteous indignation here. But we operate as fiduciaries, as a fiduciary at Retire Smart. We zealously safeguard the best interest of our clients. We take great care of their retirement dollars. Now, some of those dollars are paid in taxes, and we expect the government to be just as diligent a steward with our clients' tax dollars.
I don't necessarily think we expect that. We would wish that for sure. I mean, that would be our desire
corrected.
And our hope.
Well, I stand corrected. I have no choice, because here's the headline from Fox Business. This is Joni Ernst, United States Senator from Iowa. Ernst calls out federal fraudsters who took COVID-19 unemployment while getting paychecks from taxpayers. David, these swamp creatures falsely claim that they lost their jobs during the pandemic while they were still on the government payroll. Oh my goodness.
So they were all sent home, if you will, but they were still all getting paid, and then they all went on. And this isn't just like a one or two bad apples, Chip. Just from the department, and this investigation is going to go wide, so there's going to be more departments uncovered. This is going to be a pretty big deal. We'll see if all news outlets decide to cover it. But just from the Department of Homeland Security, we have identified over 2,000 people who fraudulently claimed benefits while still getting fully paid, and in some cases claiming overtime and getting paid as if they weren't there and taking COVID relief benefits because they claim they had lost their job. And these are employees of the federal government. So you talked about, we would hope, or I said we would hope, you said we would expect the government to be a good steward. I just don't, because they have such overreach. We have such a big government with so much wasted. We don't have time for that today. But this is the problem, is one hand doesn't talk to the other, and that's why people can get away with this fraud. Now, they're not the only people that fraudulently took dollars from the government during some of this COVID relief. It is estimated that we're talking probably over $3.7 billion in improper use of some of the funds and the stimulus packages was taken out just by this group of folks here. But there's going to be lots of folks that are trying to, hopefully they claw back, and we'll see what happens, Inspector General, et cetera. But this is really disconcerting, because this is exactly Here's people that were gainfully and actively employed. We're blessed to have jobs by the federal government, which gives COLAs every year, regardless of what the economy's doing, which gives incredible benefits. And again, I could argue all day long on all those things. They gouge the taxpayer, by taking, these fraudulent dollars. Anyway, so yeah, that one really, really kind of shocked me when I saw that story, and I sent it to you like, hey, we got to get this in the show this week.
Well, there it is. I thought getting it out of my system would help my mood. It's not, so let's move on. Let's get back to the big picture. The economy, the numbers, the data. This also is a headline from Fox Business. U.S. GDP grew at 2.9% pace in fourth quarter as economy cools. So 2.9%, that's not a bad number, but this suggests that we're trending downward instead of upward.
Yeah, so on the good side of it, it was a better than expected number. They were expecting around 2.6, and it came in 0.3 higher. On the bad news, though, it's lower than the previous quarter, so we are definitely trending down. We were at 3.2 the previous quarter, so we're heading in the wrong direction. And unfortunately, I believe you're going to see that continue here in 2023. But when you break it down, how they were calculating some of the things in there, it wasn't even as rosy as they put it. And then we just got job data this week, like the private payrolls that we get from the big employment pay companies like ADP, was a very low job growth number. In fact, much lower than expected. And so we're starting to see economic data that is what we've been talking about. Inflation, while still high and going to be around and sticky for a while, is trending down, and that will most likely continue and will turn into a problem of deflation. But we're in a deflationary environment now, Chip, and we're in a dropping growth of earnings, and so that is a real problem, and why the economy is really going to suffer. So it's not going to be based on traditional metrics, and so that's why you have people saying we're not in a recession because they just want to look at the GDP metrics. But when you start to see job layoffs, and we'll talk about some of those later in the show, that are starting to mount as people become unemployed and the credit cards are maxed, that's not going to bode well for the economy in the coming quarters. So not great news out there right now.
Well, let's pick up on that point that you just made, David. This also is a Fox Business item. Imminent earnings recession could tank U.S. stocks, Morgan Stanley warns. Well, first of all, what is an earnings recession? And secondly, is this Chicken Little, or is the situation really this bad?
So, when we have negative growth in gross domestic product, that's a recession in the economy. An earnings recession is when you have negative growth consistently in the stock market or the corporate earnings. And we are seeing that drastically. So last year, most of Wall Street's consensus estimates had 2022 where the stock markets, the S&P 500, for example, would earn $250 to $265 a share. Most of those consensus estimates are down around $220 and continuing to drop. Our estimate is actually under $200, and Morgan Stanley talks about a $200 earnings number. So and then you have to just apply what we call multiples, Chip. This is really important. All right, so the stock market historically trades somewhere around 17 times earnings. So you're willing to pay for 17 times as much money as they earn. And if the economy is growing and they're earning more, then the appreciative value of the stocks will rise in value. Well, if you were to have $200 as the number this year, and we talk about this at our State of the Market update, and you multiply that by 17, what's 200 times 17?
So we're talking about a $3,400 swing?
So that what $3,400 would be the estimated value in that particular modeling, if you will, of where the S&P's fair value would lie. The S&P is trading, as of this recording, between 4,000 and 4,100 points. That would be 600 points of a drop, or at least 15% in that example, that the equity markets could lose if that's what came to fruition in the coming quarters. And again, why it matters, and we're not saying that that's necessarily what's going to happen, but you need to take heed and understand that, hey, if earnings start to slide and job losses start to mount up, that doesn't bode well for the economy, and it's almost a spiral effect that one stacks on the other, and then the earnings could go even lower. And by some estimates, you could see the stock market, by some people's estimates, go even significantly lower than that. Again, no one's prognosticating here exactly what's going to happen, but we need to be prepared for that possibility, and we want people to prepare their portfolios for that possibility. Do you understand how much risk is in your portfolio? Do you understand how much volatility is in there? We have a really neat tool we use that we can help you understand how much risk is in your portfolio, and we'd be happy to do that for you, complimentary, if you'd like to take advantage and get a risk assessment. That is the R in the report card, and we'd be happy to do that for you complimentary.
The report card, as David said, complimentary, no charge, no obligation. It's a comprehensive review of your entire financial situation. David just mentioned risk management. How about tax strategies? We've been talking about that, and we'll talk about that some more. How about medical expenses? How about sources of income? That's everyone's number one concern. We look at all of it. All right. This is going to be an unprecedented year financially and economically, 2023. Nobody knows for sure what's going to happen, but there are a lot of storm clouds gathering out there. Don't panic. Don't become paralyzed. As David likes to say, be proactive. Let's get out there and make a plan. Let's work out. We have more than 60 strategies to deal with various economic situations. Let's get some plans, some contingency plans made so you'll be able to navigate. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, it is vital that your estate plan is properly integrated with your overall retirement plan, especially where taxes are concerned. That's why we partner with estate planning attorney Colin Kastrick. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. The A in a SMART plan stands for advanced planning for all aspects of your retirement. That includes making sure your loved ones are taken care of after you're gone. Estate planning is a key part of your overall retirement plan. That's why we partner with an estate planning attorney, and he's with us today. David, please introduce our special guest.
Yes, thank you, Chip. So glad to welcome back into the show our good friend and attorney, Colin Kastrick. Hey, how you doing this week, man?
Good. How about you? Thanks for having me on again.
Absolutely, it is my pleasure. So we got a little bit of news for you professionally. Anyway, you've made a little bit of a change here in the last time since you've been on.
Yeah, change in the legal world there. So I joined a new firm, and so the old firm I was at was kind of a boutique specialty firm. We all did the same thing, right? A great firm, nothing wrong with that. But I've joined a firm here kind of as a partner, and it's more of a full service firm. And so not only do I do estate planning, business planning, I'll do the same stuff that I've been doing, for years. But I've got new partners now that do litigation work, that do some things that I don't do. And so we can really use that, use those synergies together to make it a better service for the clients.
Very good.
So,
and full disclosure, so Colin is someone we refer clients to often, but he does now actually lease space from me, so he does have an office on site here, his own, lock and key, etc. But for him and his partners, they do lease office space with us here. But of course, we never revenue share, etc. So if we refer folks over to Colin, it's because we think he does a great job, and he does. And by the way, Colin, I just give you, my shout out. He does my personal business and estate planning needs, and has done a wonderful job over the years for me. Now, speaking of estate planning, we've got an actual class that you, along with Mike Schutel, one of our advisors, will be teaching this coming up week, and we'll kind of get to the details there. But I always kind of look through estate stories, if you will, that we find on celebrities. And unfortunately, we recently had someone pass away, a celebrity, which and this one spooked me because I'm in the same age as this celebrity that passed away. We're literally 2 months apart. She was also born in 1968, and I'm talking about Lisa Marie Presley, Elvis Presley's only daughter, and recently died. But in the news already is her estate, because her mother is basically suing the estate, saying, wait a minute, I'm supposed to be getting some of this stuff, right?
Yeah, it's crazy. It seems like it's always bad news with these celebrities that have these estates. They either don't plan, and in this case, she actually did plan. She's created years ago these tools called ILITs, which are great for high net worth, individuals, and they're going to come into play here as the tax laws shift. But yeah, this time she did everything we thought was right, but there were some amendments made. She listened to probably the wrong people, and now mom's coming in here saying that those amendments weren't right, and causing all kinds of problems. So we're probably going to see this litigated, just like we saw Michael Jackson's, just like we're seeing Prince's. And so, it just seems like they can't win on this.
Yeah, so you put in a good point. Number one, she was proactive. She did do the work. She put in the estate documents. So we'll get back to that in a minute, why there's still some issues and why it's still being basically going to be challenged, if you will. But there are celebrities that die without an estate plan, and Prince is one that comes to mind, or those that come in with partial plans in place. And so Michael Jackson, who had a massive fortune, and that took, a little over 12 years before that was settled, I believe, from his death?
Yeah, last year it was finally settled. He died in what, '09, and it was he had a will, and now he needed much more than a will. But yeah, that's what happens when you don't have adequate planning.
And so I cannot stress enough, folks, regardless of your net worth, you need to have your documentation, your desires documented, and then you need to have it in a way that is going to facilitate your wishes in general. Now, there's always somebody that could always challenge what you put, and there's provisions and things you can put in some of these documents to help minimize that. But in the case here of Lisa Marie Presley, and so she had a $35 million life insurance trust. So basically, Colin mentioned an ILIT. That is an irrevocable life insurance trust. So these are typically vehicles, trusts someone like Colin's going to create for the client to basically transfer inside or purchase inside of the trust life insurance that is going to be held outside of the estate. So it's no longer, you cannot revoke this, you can't bring it back. But because you did that, it's outside of your estate, so you don't have to worry about estate taxes, correct?
Yeah, and it's a great tool. It's the first thing that attorneys like us go to when you have a little bit of higher net worth individual there. And so it's just a tool to, like David said, that estate tax, which is brutal. It's 40%, and they keep trying to up it. And, some big changes are coming in the next couple of years. I'm sure we'll be talking about those in the next couple shows here. But, yeah, you're trying to get all that money and outside of your estate. So if it's outside of your estate in these trusts like ILITs, attorneys like acronyms. We got a million acronyms. But ILITs, if it's outside of your estate, it goes to your kids or whoever you want to give it to, estate tax free. Or some people use it to, the real high net worth people say, hey, I'm going to stash some money over here in case I need to pay it. It's paid through those funds. And so it's kind of a neat tool. And like I said, it's the first thing we go to because it's the easiest. Those life insurance guys lobby phenomenally at Washington, and so it's been exempt forever.
Absolutely. And that's just it, is there's always these lobbyists that can always carve out different angles, and that's why you have to get competent advice from whoever you're going to seek counsel from to make sure you're staying up to date with any changes. Now, speaking of changes, so she did the legwork. It looks like this was put in place back in the 90s. So she was thinking properly. She started to gather net worth, obviously being Elvis's daughter. She had some assets just from that. But she amended the trust, and so at one point her mother was one of the trustees listed, and she removed her mother as the trustee and put on somebody new, and that's what's basically being challenged.
Yeah, and so when you remove a trustee, you're supposed to give notice to that trustee saying, "Hey, we're kicking you out. We're giving you the boot here." And Mom said she never got that notice. She said there's some questionable signatures on that notice. It doesn't look like it's something she executed. So that's a big thing about attorneys amending things. And so I see it a lot where I have clients come in and they say, hey, I've got this trust and all we need to do is amend it. And it's really difficult for attorneys like me to amend somebody else's work because it's just different. We just look at things differently, and it causes challenges like that. And so we always like to say, if you're going to get a estate plan done, it's nice to stay with one attorney you really like, or to let the new attorney just redo it for you instead of doing these amendments. And so they cause all kinds of problems, and they open up for lawsuits, and that's what we don't want, because when people sue the estate, the beneficiaries lose. The lawyers win, the beneficiaries lose. And so you want to make sure it's correct and done right.
And even in small estates, that is the case. I would tell you the beneficiaries lose and the lawyers win. We are going through a bit of a difficult a problem right now with my own mother and her husband that passed away, with his adult children and her adult children, on just some estate matters. And we're well over a year now, and it's not a large sum of money, but it's just making sure the I's are dotted and the T's are crossed and the intentions, et cetera, are left out. So again, the lesson learned here is exactly work with somebody that is competent, that you like, and that you would like to basically keep, so that if you had to make changes, which we recommend, by the way, reviewing these documents every 3 to 5 years, because life changes. Your net worth changes. You may have new beneficiaries you wish to add that you didn't think about, like maybe new grandkids or great-grandkids, etc. And if you're not updating this, it may not be what you originally thought or intended, right?
Oh, it happens all the time. We have clients who come in and they have estate. Now, thank God they did something. A lot of people do nothing. At least they did something, but it's out of date. And so the easiest course of action most of the time for that is just to redo the plan. All right, re-execute the documents, give them new documents, and then we have less problems like this where we're having competing documents. The other thing, it sounds stupid, but we have a lot of times, if you're going to execute new documents, right, get rid of the old ones, have them shredded, because otherwise, if we've got 6 different documents sitting
Right, somebody
there,
turns up. No, here's the document. And, no, so absolutely, you not only do you want to create the new ones, you want to destroy the old ones. Basically, effectively getting rid of those. So, all right. So all these things we talk about, you and Mike Schudel kind of present the basics of why you need this information, what the basics that you are in a state or need in a estate plan at this class coming up. When are you guys doing that? That's coming up this week, right?
I believe it's coming up next week there, the 15th and 16th of February. Or in 2 weeks, that is now. I guess I'm trying to get my dates right here. Yeah, Mike and I, we talk about kind of everything. We start with real basic stuff, what does everybody need? And then we talk about what are these documents. So many people hear these names, wills, living wills, advanced directives, all those things that lawyers spit out at you. And we try to break them down as simple as possible and say, this is what this is why you would need it. And so it really gets you down to the basics. And we talk a little bit about a more advanced planning, but just kind of give you a nudge. And so it's a good way to sit in and learn about the basics, ask some questions. Very rarely you're going to get a lawyer for free, and so to ask questions to them. So, take advantage of it. And 2 lawyers, because Mike's got his JD too.
Absolutely. And so that's why we provide these educational classes of all different content. So not only our clients can get educated, but the listeners of this show can get educated if they want to, just to understand the basics and the parameters. And then typically at the end of those classes, if they would like to, to follow up with you guys give them the information how to do that. So guys, if you would like to attend the estate planning workshop with Colin Kastrick and Mike Schudel, that will be on Wednesday, February 15th at the Midwest Learning Center at 6:30 p.m., or you can attend the next night, February 16th, on Thursday, again at 6:30 p.m. at the Midwest Learning Center. All you have to do is give us a call at 402-369-7777. Now, just in about 30 seconds I got left here, you need to be updating people that just maybe did their documents in recent years, because Nebraska, we had some significant changes here, right, in just the last couple of years. And this year we changed the inheritance tax a little bit, and exemptions have been changed. Does that mean people need to kind of just quickly review, even if they had a recent document done?
It's never a bad time to get a review on those documents, making sure they're complying with the new laws. Nebraska's actually headed in a good direction, for once in the state with taxes, which is pretty rare. So, there have been some added exemptions. They've upped the inheritance tax.
Still only one of 6 states that even has an inheritance tax.
Yeah.
Let's get rid of that legislature.
And Iowa made some changes lately, too, that are really beneficial. So I always say Nebraska's about 5 years behind Iowa. So hopefully we're seeing some of these trickle over the river there.
Very good. All right, well, we're out of time for today. I appreciate Colin stopping by. Again, if you'd like to get registered for that class, come and meet Colin in person and just learn some basic information, sign up for that course. Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, first a question about Social Security. I saw an article in which Senator Joe Manchin said the easiest and quickest way to fix Social Security would be to raise payroll taxes on the wealthy. Do you agree?
Well, that just happened, whether you realize that or not. And again, the current administration told everybody out there that nobody would have a single dollar of tax increase in any way, shape, or form that made below $400,000 a year. Well, I'm here to tell you that's not true on many factors, but Social Security tax just went up for anybody that's making over $160,000. So these are not super wealthy people. But basically, you have to understand is they increased the wage in which you're allowed to keep paying Social Security tax. Last year, that number was capped at $147,000. Before that, it was $136,000. Now it's $160,000 and change. So that's a $30,000 increase almost that you're going to be paying Social Security tax, which is 12.4%. So in other words, your employer pays half and you pay half. If you're self-employed, you're paying it both. But it's being paid on your behalf and it's built into your wages. So that's a tax on anybody in that income bucket automatically into Social Security. Now, in reality, do we need to get more money in Social Security? Yeah, because people are living longer. We have not actually, and we just passed, Chip, the Secure Act 2.0, which changed distribution math on, and we did quite a bit of that on a couple weeks ago, and we'll talk about that more later this year. But it pushed back when you would access retirement accounts or when you would be forced to. And for anyone born after 1960, it's gone back to 75. Why did we not simultaneously push back when you draw Social Security? If we're living longer, that's the fair thing to do. So, again, no one wants to be able to do this because it's a political hot potato, regardless where you are. Oh, you're taking away their benefits. So if you're the brave soul that says, hey, maybe, and Joe Manchin here is exactly saying we need to fix it. I believe it needs to be a combination. I believe too many Americans rely on, in your book, Fix It Now. You talk about Social Security. You would like to just rip it out and just get rid of it. But it's just one of those things that's embedded in the fabric of our country for almost 100 years now. About 90 years we've had it here. So it's not going away. So why not fix it? So his proposal is exactly to raise how much income you pay tax into that. But I would say you can do that to a degree, but it can't be the only way you fund it. What we need to do is we need to start taking people seriously and pushing back the ages. We haven't done it since 1983, Chip. So in 1983 was the only time from 1935 we instituted that we actually pushed back the withdrawal dates, and we only have been back 2 years. Well, since 1983, life expectancy has increased by almost 6 years in America. Therefore, we should be pushing back significantly the withdrawal dates. So you should not be able to, I think anybody that's under the age of 50 shouldn't be eligible to draw it at 62, unless it's disability, etc. We should be pushing that to maybe 65, and then full retirement age might be 70, and then the max age maybe go 72 for those folks. In other words, if we actually really just push some of this back, you can solve Social Security, quickly. And the other big thing is understanding how big each generation is, Chip. Nobody talks about that. We have this, what I call, barbell economy of generations. So we have the greatest generation that's very small today. Those folks are 84 years and older today. And amazing generation that fought World War II for us, et cetera, right? But now you have the baby boomers, which I believe you were part of. And but you guys were the largest generation in history. Over 88 million people were born into your generation. My generation, Gen X as we're called, is less than half of that size.
Well, see, that's the other big problem. I don't have the numbers in front of me, but as you've noted, people are living longer. When Social Security was set up in 1935, it was something like 130 workers for every one recipient of Social Security. Now it's more like 3 to 1.
Yeah.
And so
the
numbers require some kind of accommodation.
Well, Social Security actually now, about 2 years ago, started sending out more money than they take in via the tax, right? Mm-hmm. So they're actually sending out more than they take in. So what we're going to have to do is delay how we draw. Now, here's the good news, though. The generation behind mine is larger than yours, and that's the millennials. There's over 95 million millennials estimated in this country, and they are just now in their early 40s and starting to earn money, and they're paying this payroll tax, which will fill the coffers. But we have that generational gap, about 2 decades, that we're really going to need some help. And again, I just think if you simply actually push the number back and then maybe just add slightly a 3% COLA raise to that income number that gets taxed, you could solve this. I don't want to pay more taxes, but I'm at least willing to show you that a problem like this, with logic and reason, could absolutely be solved.
Well, good luck, Gen X or whatever you are. Won't be my problem. All right, a 401k question, David. I'm 52, and I want to retire in 10 years. My 401k is a big part of my retirement plan. My employer was acquired by a larger company, and my 401k has been frozen. Should I be worried? Is there anything I can do about it? Have you heard of a situation like this before, David?
Okay, so typically what happens when an acquisition happens, the larger company, they have to freeze the plan because they are basically going to roll it into the larger company's plan. So typically speaking, you don't need to panic. This is going to just be basically they're going to roll that plan in, and they may shut this plan down. That is common as well, and then just let you start contributing to whatever their plan is. And so if they freeze this plan, they will send you some documentation that tells you what your options are. So we've seen this happen a couple of different ways. One, it typically gets just merged into the new company's plan. But sometimes they'll just kill this plan and it's frozen. By frozen, what it means is you can no longer contribute to it, Chip. The plan is shut down. And then you're allowed to take those dollars and roll them out into an IRA. You could take it to the house, but that would be a tax hit. And at 52, not only would you pay income tax, you'd pay a 10% penalty on top of that. You most likely don't want to make that decision. But if they give you the option to move those funds, you can then move them into an individual retirement account, it's an IRA, and you can have those professionally managed by someone like us, or do this yourself. I mean, either one, it could happen. And then you want to figure out what to do with those dollars. This may be a golden opportunity, though. At 52, if you could move it to an IRA, with lower tax rates today, available just the next 3 years, you may be able to facilitate small Roth conversions, filling your current tax bracket at rates you're never going to see again, most likely in your
Take
lifetime.
your tax hit now so that later when you withdraw it, it'll be tax-free.
Right. So in other words, in this example, let's just say for a simple number, this gentleman had $100,000 in the old 401k, starts contributing to the new company, but they allow this one to roll. He rolls the $100,000 out, and let's just say he's married, filing a joint tax return, and him and his wife just earn, let's say $120,000. They would be in the 22% tax bracket today, and I assume he thinks his wages will go up over time, so he's not going to go lower. So he'd have about $40,000 or so room there in that example, Chip, where he could move $40,000 from his IRA to his Roth IRA. He'd have to pay the tax bill on it, but he'd be paying 22 cents today versus 25 3 years from now. And then the compounding growth of those savings can turn into a big number as early as age 52. So there may be a golden opportunity. Do not panic, but you can contact your HR director to get the skinny, if you will. But typically what they're going to do is offer you the new company's plan.
David, we had a question come in, actually a series of questions about currency that came in from a listener via our website just this week. I'm going to roll these out for you and let you take them in whatever order makes the most sense for you. But here's the series of questions. Can and will our dollar crash? Is the Fed coin going to replace the dollar regardless of who's in office? If it does replace the dollar, what happens to my emergency cash, or for that matter, the tens of thousands in various cash accounts I have at present? If foreign countries continue to move away from the U.S. dollar and or replace it as the reserve currency of the global economy, where does that leave us? I kind of sanitized it at the end. The questioner was a little more graphic of what dire circumstances could result. But David, have at that series of questions.
All right. So this has been a common theme for, since 40 years, since we went off the gold standard, right? Everyone's always said the dollar's going to crash. The dollar's going to crash. Now, do we have some inflationary pressures? Do dollars become worth less over time? Absolutely. The more a Fed prints money, that is absolutely true. However, the dollar is still the world's currency, and that's not going to change. I know there's a lot of rhetoric out there, and most people know me. I'm pretty fiscally conservative. I lean to the right politically, but you do not have to worry about the dollar actually going away. Now, there's a lot he brought up in those questions there. So the Fed coin, we'll talk about that in a minute, because unfortunately that is going to come true. So we'll talk about that. But the dollar is the reserve currency for over 65% of central banks across the globe. Okay, and even that countries are trying to use their currency. The euro was created to try to take over the dollar. That's the whole reason you had basically 17 countries get together. They wanted to have something that people would back. But as we've seen, poor fiscal management by these other countries has left the euro in dire straits. In fact, the dollar's gotten stronger. And when the world goes through recession, the dollar stands up because we are almost always the shining light on the global economy.
So that term reserve currency means the default currency, the standard currency for world transactions.
Correct. And so the euro is failed miserably, and it's not going to take over. So the only logical currency available today would be the yuan, basically China. Here's the problem. Nobody in the free market, only communist countries would agree to make the yuan the reserve currency. Why? China doesn't let their currency float. In other words, it does not get priced at a free market. They set the rate of their currency, where the dollar, it floats against currencies. And so while it does get weak at times, get stronger, it's a real true value at that moment in time. And on top of that, we made an agreement with OPEC nations way back in 1958 that all oil they sell would be in dollar terms, and we call it the petrodollar. And that is helping secure, even today, even this move to green energy, et cetera, the transactions happen in dollars. Now, certainly is oil trading right now between Russia and China, et cetera, in non-dollar terms, but the global economy is sound enough, and the amount of dollars that these other nations that would like to get rid of it own in U.S. dollars and couldn't get their money could be in trouble. Now, I'm not going to have time today, going to run out of time, Chip, but the Fed coin is something we'll talk about maybe next week or the week after, because, yes, the Federal Reserve has already launched a digital dollar. It's being tried out right now in 12 banks. This has been going on for a couple of months, and, yes, the Federal Reserve and the U.S. Treasury would like to go to a digital currency because they can control it more, which means they can regulate and tax it. And again, I don't like that, and we'll talk about the consequences there on a future segment. But no, the dollar is not going away, regardless if you watch the gold commercials or all those. The dollar is here and will not change in our lifetime.
David, we are out of time for Q&A this week, but how many openings do we have in the calendar if people would like to schedule a 15-minute phone conference with one of our advisors?
I believe we can handle 8 this week, Chip. So we've got 8 of those openings where you can talk with a licensed financial advisor to answer your most pressing question. And the cool thing is, the signal now reaches. We've got the show on multiple channels. We're in new cities across the Midwest here, and we get people a call from 3-4 hours drive away. And so it's a great way if you're a little further outside our Omaha city limits for convenience to just get on the phone with somebody.
402-369-7777. No charge, no obligation. Schedule a 15-minute phone conference with one of our licensed financial advisors. We have 8 openings this week. Don't dally. 402-369-7777. Up next, Goldman Sachs says the housing market in 4 major cities will crash in 2023. We'll tell you which ones next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, got a Fox Business headline here. Goldman Sachs says 4 U.S. cities will suffer a 2008 crash in home values. David, what are the 4 cities, and do you agree with this prediction?
Yeah, we've been talking about real estate having to go backwards a little bit. Now, I don't know if we're going all the way back to 2008 levels, but we're going to see a correction. And when cities get what we call parabolic prices, and the cities he's mentioning here, by the way, are San Jose, California. Obviously, that's the tech area, and they're going through a massive job cuts right now. Makes sense it's going to go backwards because the prices just got literally, out of sight. San Diego, California. I was actually recently there, and a beautiful town, but again, because it has perfect weather, the prices were through the roof. Austin, Texas, which has seen a boom. That's where most of the exodus of companies from California ended up, and the housing market went through the roof. And then, of course, Phoenix, Arizona. We have a lot of folks that are snowbirds in this area that kind of live their part of the year up here, and those houses are going to drastically decrease. And according to Goldman Sachs, we're going to see a 25% retracement in their prices. So that can be painful. So imagine if you spent, Chip, $600,000 to buy your retirement home down in Phoenix last year. That means your house could go backwards $150,000. That means your house is, now only going to be worth $450,000. Now, if you paid cash for it, had the means, and are never moving, does this affect you? Not in reality. But if you've got a mortgage on this property and you finance, say, a $500,000 under a mortgage and put down $100,000 cash, and it's only worth $450,000, is that a problem? You betcha, because now you're underwater. You have negative equity, which puts you in a very precarious position if the economy were to really spiral out of control, and if you had to sell your house for some reason. Now you actually have to bring cash to the closing table. You brought cash to the closing table to buy it. You'd have to bring cash to the closing table to sell it. And so it's going to get ugly in some of those cities where those rates, we had those parabolic increases of 20 and 30% price year over year for a couple of cities. Florida's going to experience some of that. They had some growth. But now here's the good news. Again, we talk about here in Omaha, we're a pretty good city to have to weather a recession in. According to our data, number 1 of cities of at least 500,000 people in them. And house prices here are going to go down. I actually recently just made another acquisition on my rental portfolio, and the original asking price and what Zillow said the unit was worth, we ended up purchasing it for over 20% lower. And that's right here in Omaha. So we're starting to see some prices shift, and people that may be more motivated to sell will be willing to cut their prices a little further. And so I would just tell people real estate is going to get hit nationwide. We think 10 to 15%.
But it sounds like you're still bullish on real estate as an investment.
Absolutely, because if you're not needing to sell the property, again, everybody's in a different position, but if you're acquiring property, this may be a great year to acquire property when the values go down if you're planning on holding it long term. And my primary way my wife and I invest in real estate is buy and hold. So we purchase them and rent properties, and we've got several of those in lots of states, et cetera. But that's something we're experienced doing and are okay with it. I mean, I tell you, I bought one last year. I probably overpaid for it, but if I don't plan on selling it anytime soon, that doesn't really bother me too much. But I would tell you, this also brings in another unique factor, Chip. It's called the wealth effect. And real estate is the number one way Americans acquire wealth in their home primarily, right? You buy a house, you live in it 20 years, it's typically doubled in value. You feel like you're wealthier. Well, if that goes backwards in value significantly and you start to look at maybe home reports or one of those apps like Zillow or whatever and your value, it makes you feel less wealthy. It makes you feel less of ability to afford things, and that slows down your spending. And the wealth effect, and that's part of behavioral finance. We could talk about that in a future show, why that will help accelerate, unfortunately, recessionary and earnings things that we've been talking about.
David, you sent me an item from Russell Investments, and the headline made me do a double take. And it says, negative returns do not equal no taxes. Tax drag can hold you back in up and down markets. I did a double take because, wait a minute, you're saying even if I have a negative return, I might still have some tax liability? What's going on here?
So, yeah, we try to make sure people understand there's certain investment vehicles you may be utilizing. Mutual funds is one we talk about. We don't utilize a lot of them. We do use some that we just think they're the best vehicle in a particular circumstance, but it's not heavily utilized because mutual funds are created, Chip, in a way, the structure, they're what's called an open-end investment vehicle. They have to pay taxation on the gains within the portfolio. So imagine you own a mutual fund, Chip, and let's just say you bought it, I don't know, a year and a half ago. You invested in it, you went and sat down with somebody and they put you in this mutual fund. And if you're working with a broker versus a fiduciary-based advisor, somebody that was based a commission, they sell these in what's called A-share mutual funds. They usually have some kind of, typically about 5.5% commission built into the fund. So you're down 5.5% day one, and then it will make up over time. And the way they kind of justify that is a lower expense ratio. But anyway, the fund then is supposed to grow over time for you and obviously give you a return on your money. Well, when the markets decline like they did last year, the fund manager's job, Chip, is to protect you. So what is he going to do? He might want to sell some of the assets in the fund and prevent them from dropping even further in value, doing his job and trying to maintain the growth and protect the investors in the fund. The problem for you, Chip, is if you just bought into this fund, he might have sold an asset he bought 20 years ago in that fund because he wanted to protect and lock in some of those gains he's made over the last decade or so. Let's just say he had Amazon, right? And Amazon went through the roof in the last 2 decades, and then he started selling it. It was really declining hard last year. Who pays the tax on the gain from even if he bought that 20 years ago?
Wait a minute. You're going to be shouldering the tax burden for gain that you didn't actually experience.
Shareholders of record
in
the year inside the fund are the one that pay the tax. And sometimes we call this a phantom tax. This actually happens, Chip, not only in your non-qualified accounts.
This is coming back to me because you've described this to us before.
This can happen in your 401k or in your IRA. And so we call it a phantom tax. You basically paid a tax. And so some people will get this 1099 showing up with the tax bill if they had these funds, and we see this all the time when we review clients' tax returns. We had actually a client in this past week lost significant money. This was a very large family trust fund, had about $6 million in this fund, built to last over time, money not needed. This family is doing okay. They had $140,000 or so, if I remember correctly, in capital gain distributions. Not gains they realize, but taxes. They're paying taxes on this year. They just came in our office this week, and when we looked at that, I'm like, were you aware of this? And, of course, the answer was no. So you don't know what you don't know, which is why you have to have someone give you a very good overview, a 30,000-foot view, a holistic view. Ours is what's called a proprietary smart plan. Again, we're not the only shop in town. We encourage people to sit down with fiduciary-based advisors in general, but have somebody that's got the wherewithal, the expertise you're looking for, the experience, and the tools to give you this type of insight. And that's why we created the smart plan here at Retire Smart.
David, our final item this week comes from the Wall Street Journal, and here's the headline: The Decline of the Nice-to-Have Economy. What's this all about?
So these are a lot of companies that spurred out of economic growth here in the last 5 to 6 years in particular. And so this was almost like, and they exploded during COVID. So convenience items, delivery at home food, right? So you had meal kit companies, and one mentioned in the article here is a company called Blue Apron, and Nestle, a big parent company, spent over $950 million to acquire them. Well, they're not worth that today, okay? And so you've got other ones like HelloFresh that are trying to hang in there. You had car buying companies pop up, like Carvana had amazing significant growth, and this is where they had the car vending machine. They're financially unfit and may not make it out of this. There was tons of these Peloton bikes, all these companies that had all these ancillary service subscription based, and people were signing up. They had discretionary income. They had time on their hands. Discretionary income's going away fast, and these companies are doing the same thing. So it's just unfortunately, a recession is going to wipe out companies like this quite often.
Times are churning, times are changing. Don't panic. Take advantage of everything we offer. We've got the inflation guide, of course. We've got a 15-minute phone conference with one of our advisors. 8 of those are available this week. Take the plunge, get the report card, the comprehensive review of your entire financial situation. No charge, no obligation. And don't forget about our next round of estate planning workshops. These are no charge, no obligation, but you must call to register. 402-369-7777. That's Wednesday, February 15th, or Thursday, February 16th, 6:30 p.m. right here at the Midwest Learning Center at Retire Smart. 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll look to you next weekend.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Attorney Colin Kastrick is not affiliated with Retire Smart, is not a client, and was not compensated for his appearance.